Hello, and welcome to BARR Financial Services market commentary for the first quarter of 2012. These commentaries are provided to keep you informed of our views of the markets and the economy. We hope you find them helpful and beneficial. Equity started the year strong. Improving U.S. economic data and recent policy steps toward mitigation of the sovereign crisis in Europe provided the support for equity markets worldwide. We believe the stage has been set for improvement in the equities over the next 12 to 18 months. But keep in mind, the markets will most likely be volatile this summer. Currently, market volatility is a 3-year low and has provided the backdrop for investment gains. A good fourth quarter earnings season, supported by stronger leading economic indicators, helped increase investor sentiment and the equity markets. For the quarter, the S&P 500 climbed 12.6%, which brings the annual return to 8.5%. This robust start to the year brings the stock market rally, which started March of 2009, to an overall growth of the S&P up 122% and is less than 1% below the peak reached in October of 2007. Global markets recovered somewhat in the first quarter, with the EAFE index up 11% and emerging markets at 14%. Both of these indexes are down for the one-year track record at a negative 5.3% and a negative 8.5% respectively. The threat of a sharp global slowdown eased with improved activity in the U.S. and better policies in Europe. The weak recovery will likely resume in the major advanced economies, and activity will remain relatively solid in most emerging and developing economies. Equity valuations seem reasonable relative to corporate profits, the amount of cash on their balance sheets, and the low interest rate environment. Current PE ratios versus the 20-year average show that large cap and growth equities are undervalued, and there's opportunity for growth. This is important as we hold strong positions in these areas. The forward PE ratio of the S&P index, most recent reading of 13 times, is well below the average of 16.2 times. In my opinion, valuations itself is not a good predictor of short-term market moves. Last year's up and down performance was a case in point. As indicated by the graph, real gross domestic product, GDP, for the fourth quarter came in strong at 3%, above the 20-year average at 2.6%. For the first quarter, GDP came in at 2.2%, which is slightly below the 2.5% estimate. I expect the tempo this year to pick up in the second half of 2012 and stay up through year end. Still, growth will run shy of the pace needed to significantly lower the unemployment rate. We anticipate GDP to end the year around 2.5%, which is much better than the lackluster 2011 performance of 1.7%. The Conference Board's leading economic index, LEI, for the United States continues its vertical climb and increased 0.3% in March, following a 0.7% increase in February and a 0.2% increase in January. Quoting Ottoman, and I cannot pronounce his last name, economist at the Conference Board, and I quote, "The LEI increased for the 6th consecutive month, pointing to a more positive outlook despite subdued consumer expectations and weakness in the manufacturing new orders. Moreover, the 6-month growth rate of the LEI continues to improve. The CEI, a measure of current economic conditions, has also increased in 5 of the last 6 months, with broad-based gains in all components." According to Ken Goldstein, economist at the Conference Board, we expect a gradual improvement in growth past the summer months. Eurozone. Things were quieter in the Eurozone during the first quarter, but the sovereign debt crisis remains on investors' minds. The Greek bailout was reached, and the bond swap program continues to move along. The Eurozone GDP contracted in the fourth quarter, and unemployment was at a 15-year high. The economic recession in the Eurozone will continue to be a drag on the world economy and may reignite concerns about the sovereign debt crisis. This could add volatility to the markets and slow U.S. growth. The consumer. The consumer has been the missing link in the recovery until now. After 4 years of saving in an effort to build stability and restore lost wealth, consumers are finally opening their wallets. The first quarter showed an increase in personal consumption expenditures and healthy growth in retail sales. Add to that, the drop in all delinquency rates could make the consumer an important part of a self-sustained U.S. economic recovery. Employment. The labor market, while still weak, showed encouraging signs of improvement, with the 4-week moving average of initial jobless claims down to 365,000. Employment growth was strong during the quarter, which helped push the unemployment rate down to 8.2% in March, a 3-year low. We do not expect the unemployment rate to drop much this year, as corporations are still in a holding pattern. Housing. Existing home prices continue to bump along after dropping 26.9% from the peak reached November 2005. Home sales continue to increase and inventory continue to decline. New housing starts have increased steadily for the last several months. Mortgage rates are at historic lows, and confidence among home builders increased to the highest level since 2007. These are positive indicators that the housing market is probably turning the corner and should not continue to be a drag on the economy. Closing thoughts. The U.S. economy seems to be on the path to a self-sustained recovery, but we are far from out of the woods. The U.S. recovery could prove robust enough to withstand the negative headwinds from Europe and China. If not, the risk aversion attitude may take hold and volatility in the equity markets will return. Previous bull market rallies are often accompanied by market pullbacks. Coupled with the usual volatility in the summer months, we could experience a 5 to 10% drop in the market. This should build the foundation for market expansion heading into the year-end and the election. There are 2 significant threats to the stock market. The first is continued economic turmoil in Europe, specifically the peripheral countries of Greece, Portugal, and Spain. The second negative factor impacting the market is the uncertainty surrounding the expiration of all the Bush tax cuts and the appropriation of billions of dollars for both domestic and military spending. With all that being said, I think there's a good chance we will look back on 2012 as a good year. We have many options available to help you prevail during these challenging times and meet your goals. The bottom line is that our portfolios are well diversified and we will continue to benefit as we move forward into the uncertain future. Please contact us if you have any questions or concerns, as we are here to serve you and your needs. Thank you for listening and your continued support.